Hey, good morning. It is Saturday, March 12th, 9:57 a.m. Markets are not open, so I guess the time is irrelevant, but I'm going to do a weekend review of the markets and see where we are for our trading week ahead. Risk disclosure and hypothetical performance disclaimer, as always, are on my website. Please take a moment to review that. Dow theory first. How do I approach the market? Very simply, higher highs and higher lows, and lower highs and lower lows. That identifies the trend. And if you take a moment to review the Dow theory on Investopedia, you can see how to approach the markets to manage getting in and out of these trends between the time frames and using standard charting techniques such as trend lines and support and resistance. So with this very basic concept in mind, let's look at my chart. And how I like to approach the market is with momentum. And as always, I use a smoothed momentum. I use an indicator that allows me to see when I get a period of divergence, a lower low, but a higher low in momentum likely will mean that the market is going to be moving up. And sure enough, we're moving up in crude. And where are we moving? We're moving to the bottom of these pivots. In an uptrend, you follow the bottom of these pivots. So this pivot low right here, if you highlight that candle, you can see the low is 38.65. So if I put my horizontal line on my chart, I can click my line, right click the properties and make it exactly 38.65. And you can see that we've hit that line and we're coming back ever so slightly. So let's drop this down to the 60-minute, and you can see that we hit that line, broke through it, but we're bouncing off of it. So it got bouncy on our session yesterday, and here is our higher high but lower high momentum, indicating that we should be seeing a pullback. So where do we pull back to? It's the same thing. We start with our levels, our prior levels. It's the same thing in reverse. So the first level we're going to check is 37.20, 36.10. It just depends on how deep that pullback is going to get. If you want to look at a closer look at the sideways price action when we got to that level and how we're responding to it, whether we're going to see how the momentum dried up on that level, it's not the most optimum time to trade. You want to wait until you get a disposition off of a level with a daily bar. So we want to see a close above that level with a daily bar before resuming our long. Otherwise, we're going to be probably heading short. And what is so common about market tops or support resistance is it gets choppy and you go sideways because the market doesn't know whether it's going to break out or fall back. So if you're of the theory that you want to go with a breakout, wait for your momentum to go above zero and try for a breakout. I'm more of the theory that I rather the market break out and then come back to check that level and then take off again. So, but right now I am not getting a breakout momentum. We have a higher high, but a lower high momentum. So that tells me that we're probably going to come back and check a lower level. Let me show you another chart and another way that I approach the markets. Here is my Unirinko, custom Unirinko bars, and here's my Altogami indicator. And you can see, this is my market profile. You can see that when price pulls back, it pulls back to a low volume area. And if it rejects that low volume area, it's going to take off again. Okay, so our first pullback took off again. So this may end up becoming a breakout on Monday. But do you see this divergence here? This was our first signal that we were going to get a pullback. And so where does it pull back to? It pulls back to that low volume node. This is the the GOM MP indicator you can get on big mics. Oh, excuse me, Futures IO. They changed the name. I'm not sure why they did that, but maybe it was because he moved out of the country and had to move his server out of the country and couldn't keep that domain name. But I'm not sure. I'm just guessing. This is a high volume node and a low volume node, and in market and this is just support resistance. If you squish the chart up, you will see that price moves between these high volume and low volume areas, and all that is support resistance. You can see the resistance, you break resistance, come back and check it, and if it rejects and returns up, then you resume your trend. And that low volume node area usually occurs between the two high volume areas and at a support resistance area. And so look at this double fake out. This is why it's hard trading support resistance. You got your candle indication signifying that you were going to break off of this low volume area, but the market makers go for their stop run. You see that? They do the little double gotcha move before taking off. So just because you get shaken out of a trade, don't give up on it. That's why I wanted to show you this. You got your clean signal off of your area, but then you got stopped out, and then the market takes off without you. That is so common. So leave a wider stop, and you can see that it was only 32 to 48. So, I mean, it's a very manageable stop. Just leave a wider stop on the support resistance areas. People usually just put a tiny little stop area. That gets you each time. I know that's hard to do, but leave a $200 stop on these 20 points or 20 ticks. And it'll actually save you from staying in a trade, but you probably had to put a little bit more than 20 to get this, because you would have been entering at 92 and they stopped you out at 29. So that was a little bit wider. If you want, wait for momentum to cross zero, and that's always the best. If your indicator has not crossed zero when you get the signal, you might want to just sit on your hands until it crosses the zero line, and then you know that it's okay to get back in your move, because momentum is a leading indicator. It's the only indicator that you've got that leads. Stochastic does not always work. Stochastic can give you fake signals. Momentum usually will lead you in the right path. And when momentum is showing you that it's staying above zero, stay with the trend. See that? When momentum comes back below zero, that trend is definitely over for the time being until we get back above zero. And then again, the same concepts apply. You need to understand support resistance, high volume, low volume nodes. We actually came into a low volume node area and broke through it. Right here, we had a high volume, low volume, and we broke it. So I'm not sure if that means that we're going to come back and test this high volume area again. Could be that we're going to see some more downside resistance, downside movement. Currently, we very well could just get this 2-bar reversal back into this high volume area. And a high volume does not stop on a dime like the low volume does. A high volume area will go up and down over it. So don't use the high volume nodes as a line in the sand. Use the low volume nodes as a line in the sand. But the high volume nodes, it's just going to come here because that's where all the VWAP is, the volume weighted average price on these high volume nodes. If your theory is to stay long and you want to tuck a stop behind the high volume area to keep your trend going, that's a good theory. But I just use my custom bar direction and momentum to show me where my trend direction is. VWAP is actually right here at 34.88 on my composite chart, and the composite point of control is down here at 33.67. Seeing how this was a first test of that daily level, we very well could see a Fibonacci retracement between this low and this high. Down into 33.50 or 32.30, or even 34.70. And your Fibonacci rule is if it bounces at 38.20, you know that most likely you're going to break this pivot high again and continue with the trend. Same thing for the halfback. Very good odds that you're going to break the trend. But if it gets down to the 61.8, you could get back to the pivot high and maybe break it, but it won't last long. Go into a range, sideways pattern or something. So just be aware of your Fibonacci rules. But right now, the momentum is strong on the daily. So I would expect to see perhaps a 38.2 or 50% retracement and a return to the high side. Given the chart review off of this divergence. However, we have some fundamental factors coming into the market next week with the Fed probably raising interest rates, which would be insane. I mean, I don't know how they can do it, given that Europe and Japan are, and Russia, I mean, in China, I mean, we have a global recession. And I'll talk about the Europe thing in just a minute. But as far as our higher highs and higher lows at support resistance, find where those support resistance areas are, like I showed you, and then expect to see a retracement. Right now, we are looking like we're going to be retracing short. And try to match your support resistance areas with those higher time frame Fibonacci areas. Um, 33.50. That's a long way down, isn't it? Right here, 34.70, 33.50 way down here, the 50%. So, that's a lot of real estate to recover, to get back into a trend um, on your chart. I also have an indicator that I like to look at, and that's my super trend that you can get at Big Mike's. Or actually, if you buy one of my templates, you can get it from me. I have two settings that I like to use. And once it breaks this setting, I know for sure the trend is over. Usually the upper setting will act as a buffer. But so far, technically, according to my super trend, this trend is still alive. But I probably will expect it to pull back some more. So 3603 is another low volume area that will probably get double checked. 3486 is my composite VWAP, which is very close to this 3820 area. So because the composite VWAP is sitting right below this 38.2, I would expect to see the pullback down to this area. Just saying, nobody can prognosticate. I'm just, using my tools to make these estimates. And then I write down what I think will happen in the market. And then the next week I have a trade plan. Okay. And then I use my other tools, my weekly, daily 60-15 to guide me, as well as my core solvers on where the market is setting up as far as the open and close, with some other indicators that I like to watch. And I know the market is really moving when I get this top line going. So I can stay with the trend longer. Many tricks, many tricks, many ways to cut a cat, and obviously, do your market research. So let's look at that euro real quick, because we got Mario Draghi never fails to disappoint. What should have happened when he entered into QE and lowered his interest rate? That currency, they wanted it to fall. They did want it to fall. They wanted it to go towards parity, so that they could stimulate their economy. They got the reverse reaction when, out of his mouth, he just can't help himself, he said, "We'll never lower interest rates again, ever." And that's how he said it. And I'm sitting there going, uh-oh, as soon as it came out of his mouth, and the market started rallying. And at first I was in disbelief. I mean, just shock. Could not believe he said that. So here's the string pushing part, because this is not what they want. They want the currency to fall so that they can stimulate their economy. You can't stimulate an economy with your currency high, because you can't enter into global trade. It costs people too much money to buy your goods with your currency high. And that's why it's dangerous for us to be raising our interest rates, even though they're very minimal. When other countries are going below zero, it's very dangerous, because it's going to cause our exports are going to be too expensive. They'll just buy stuff from Russia or China, and they won't buy our stuff. So they're walking a tightrope on doing this. I would, recommend that they just sit on their hands and wait to see what happens. If they can get this currency to start falling, that's what you want. And um, we should just wait until the global um, give the global economy a chance to catch up. But of course, I'm sitting here at my computer at my desk, and I'm not a member of the Federal Reserve Board. I'm sure they know a lot more about it than I do, so I will stop hypothecating. But this is not what they wanted to see, folks. So on the daily, we are in an uptrend. So we want to see this continued fall back. We do have one saving grace in that the momentum did not cross above zero. So we could inflect back down. So be watching for a downward inflection in the euro next week, because they're going to be desperate to get this thing to turn around and go back in the direction that they want it to go in. And this could be the top, the market top, for a long time in the euro. So if you want to try to be watching this on your larger time frames, be watching for this trend to turn around, and you want to see this and start trading these when the market turns around in your direction. I like to wait for the daily to show the move first, and it hasn't done it yet. But this looks like it's the exhaustion bar, and I would be expecting next week for it to fall in line and go back in the direction that they want it to go in. I'm sure that they're going to be trading it down, the central bank will. So we might have some good short trades on the euro next week. For our E-mini, I think that the safest thing next week for us to do is sit on the sidelines, because there ain't no telling what they're doing right now with the interest rates and how the markets are going to react. What I can tell you fundamentally is that the markets are overbought. The valuations are extremely stretched, and they've been running on QE juice. We are at resistance, and we haven't been able to close above it to seal the deal. Because we're coming into our own interest rate decision, once they start driving that euro down, and if our dollar goes up, I think the market's going to come down. But again, watch your charts. Don't listen to me. Be aware of your support resistance areas. Follow the direction that the market is moving and just follow it. I mean, be a girl. Girls are responders. Girls make the best traders, because we can spot a trend and we can just follow it. We don't have to worry about anything else. In fact, if we just watch our colors and follow those, and watch the fake outs. I mean, it looks like they're faking it out. Breakout, fake out is what I think this is. But who knows? I mean, I guess I could be absolutely wrong. We're still below zero on the weekly. The momentum is still below zero, so I'm still bearish. I'm still in a downtrend on my weekly. So I'm sticking with it, okay? Right now, I'm at the crossroads where I've hit my downtrend and I'm just going sideways. So market doesn't know what it's doing yet, is what I'm trying to say. If it breaks out and breaks out, it breaks out, and I'll go with it. I can trade long or short, but it's just choppy right now. And so I might sit on the sidelines for the ES until after the interest rate decision comes out. So my best trading opportunities next week are going to be the crude market and maybe gold. Let's take a look at gold. Gold looks like it's pulling back. They've been trying to get us to pull off of gold for a while. It's still in an uptrend, but pulling off of that uptrend. This could just keep going higher as people get out of equities. People rush to the bonds. Let's take a look at the bonds. The bonds are pulling back. A new downtrend on the daily, pulling back into support on the so this may be the start of a new bear trend for the bonds. And that may be an opportunity for us also. Momentum below zero and heading down. And if we look, I'm sorry, put this back on the weekly. It looks like we could easily get down to 124, 250, or 125. So a long way to go on the bonds. We just have to wait and see what happens with the interest rate decision. So crude, bonds, and euro for me next week. Actually, I won't be trading the bonds until the interest rate decision comes out. But definitely we're in a state of indecision in the market, so we'll have to just be very careful until that rate decision comes out. Use your skills, knowledge of Dow theory, support resistance, market profile, divergence, momentum, and take advantage of these short-term swings. This is a 50-tick bar, by the way, from head to toe. And this looks like not like a lot, but that move there was $1,800 on a one contract. All right. And just be careful of a sideways market because that'll chew your account up. You want to wait for a market to be trending one direction or the other. And y'all be good, and we will see you next week in the trade room. Thank you so much. Bye-bye.